Well, volatility, the name of the game. While there is plenty of risk out there in the market, our next guest sees some factors to feel positive about investing in. For more, Robert Talevski from Activist Investors is joining us live via Skype. Robert, welcome to the program. Great to have you here. We've been talking about some stabilization in the economic reads that are coming out here in Australia, but overseas, not just the UK, but the US as well, some pretty shocking numbers. I mean, just last night we had April housing starts in the US slumping 30%. How are you reading some of the data that's coming from the US in particular these days?
Thanks for having me, Nadine, and good to see you, Daniel. I think there's obviously a lot of data coming out that's it's still going to be worse going forward. But some of the things that we're sort of focused on at the moment, the employment numbers, which I guess you can't get much worse than that at the moment. Even in Australia here, 6.2% of people are unemployed, although that sort of number is probably hiding the real impact, I guess, or the real number of people that are looking for work. Another interesting stat this morning that came out, 6 million people, that's half the Australian workforce, is on the job keeper scheme. And that's a really sort of a mind-blowing detail or stat, I suppose. So on that front, it's going to be interesting to see what happens, obviously, once that that comes off in September. And what's interesting as well, I speak to quite a few business owners frequently, and I'm getting that sense that many probably won't re-employ the same amount of people they had on their books pre-COVID. So that sort of, I guess, suggests that that unemployment number in Australia will remain higher for longer. In terms of the company earnings, I suppose, we've seen the first quarter of this year come almost sort of to an end in terms of US company earnings. And on average, we've seen the S&P 500 earnings fall by about 14%, not unexpected. I guess the worst is probably to come in Q2. That's the second quarter of this year, as more of that impact sort of comes through a lot of the company earnings. But it's interesting as well because, obviously on a broader scale, you see, falls in earnings at the same time. The FANGs, the Facebooks, the Amazons, the Netflix, the Googles, the healthcare sectors, they've done relatively well over the in that first quarter, and so they obviously will continue to do well over the next sort of 6 months. So I guess you just sort of got to look at that dispersion between, rather than sort of being on a broader scale, that some companies will probably do better than others. And we're hearing some sort of, I guess, chatter around some of the US companies deliberately writing down or aggressively writing down, and that kind of means essentially that because of that, there could be a bit of a good outcome for Q4 earnings as well. So that'll be, I guess, a bit of a surprise, which could again be a good thing for company earnings. And the other things, obviously the balance sheet as well. And again, both here in Australia and in the US, it's a really interesting stat in the US that there's actually more people. There's people with higher levels of household disposable income today than there was 12 months ago. That's a pretty powerful, stat, given obviously we are where we are now. And so that's one thing. And another, obviously, in Australia, with the government, putting forward a $214 billion, stimulus package, and at the same time, as we all know, we've all been staying home, so we've been sort of saving a bit of money. Those factors combined, it could be an interesting thing or a powerful force for I guess that consumer recovery in the next couple of months.
Yeah, it's interesting. We just briefly had some of those US based retailers on the screen. We did hear from the likes of Home Depot through the overnight period, so we are still getting a little bit of insight into the US consumer, Walmart as well. When you look at sort of opportunities in global markets and you consider all that you've said about the nature of the employment picture at this time, the likelihood of some business not rehiring, I mean, do you look at some of those consumer staples areas in global markets, or where are you sort of looking for opportunity?
Oh, we sort of focus more on the asset class opportunities, and obviously there's been some asset classes that have done better than others. Obviously the ones and sort of, I guess, one sort of way that we're moving away, we're actually underweighting Aussie equity exposure and increasing our sort of overweight to international shares. We think that the local market will probably come under a bit of stress from obviously the financials, and given it's such a large part of the index, that there will be some of that issue as well. And I guess, and the other thing is as well, in the US, they've got a very strong healthcare sector. They've also got a very strong tech sector, and that'll continue to do well. Where I think maybe, in Australia here, we probably suffer from a shortage of very, very good quality healthcare and tech stocks. So basically, we are overweighting our sort of international shares exposure at the expense of, I guess, Australia. But at the same time, Australia's done really well, and Australia will probably continue to do well. We're not sort of being too negative about it. We just have a preference for one asset class over the other. But Australia should do particularly well, or should do okay, given that we're hearing obviously now China manufacturing getting back online, and that should obviously be a good thing for the Australian shares. Okay,
so when we take a look at what's happening, moving from overweight Australian shares, overweight international shares, is it US markets in particular? Where else would you potentially look, if at all?
Yeah, US markets particularly. I think it's a very big chunk of the international share benchmark. So it's definitely that. Although I think in Europe even now, I mean, we've been calling Europe attractive and cheap, probably not investable up until the last couple of years. And I suppose now we're finally seeing some interesting opportunities in Europe as well. So I think as a combination of US, Europe, and other sort of developed countries, perhaps now that there's a better opportunity across a broader set of opportunities in the international space now.
Now, if we compare active and passive at the moment, it's clear that there are some areas that are doing better than others in this recent recovery. But what sort of timescale should an investor really use to decide whether active or passive is right for them?
It's a tough question, Daniel, because even I'm sort of, I guess, sometimes impatient. You sort of active investors will invest in obviously active managers, and there's an expectation that by paying active fees that there should be a reward quite quickly and in the short term, where I think generally speaking, it's not just about a matter of a time frame. You need to understand as well, in certain environments, some active managers will do better than others. And it's interesting, in the last month, yet another month, for the month of April, we monitor, or we provide, I guess, broader indices around active versus passive. And for the second month in a row, and in particular, the outcome for active managers was a lot better, with over 55%, outperforming their index, which might not seem a lot, but in the past, it's a lot higher compared to the past. So we're talking about active managers, 55% of the active managers in the Australian share space outperforming their respective index. But even more so, the interesting stat around that is, if you take the top 25% of the top outperformers of active managers, they did a lot better than the index. They produced something in the vicinity of a 3.5% outperformance, which, if you can get that, that's a pretty good outcome for that. And similarly, in the international equity space, again, another good month for active managers relative to the index. Just under 54% did better than the index. And again, similar thing in the sense that, and a better outcome actually, in the sense that active managers on average produced in the top quartile, the top 25% active performers did 4% above the index as well. So another bad outcome for active managers all around.
Okay, so where are you active specifically in the Australian market then right now? Where do you see opportunities? Name names.
Oh, look, we typically, we invest in managers, so we're not talking about particular stocks. But again, in on average, we're probably a little bit negative on the small caps at the moment, because we just think still, again, there is that sort of flight to safety. So we prefer larger cap companies over the small company or small cap companies. Again, quality managers is probably the key thing here. Being able to invest in active managers that will, pick the best of the best stocks and avoid, obviously, the companies that might not do well in this particular environment. So we're sort of favouring the quality managers as well. I guess the active managers that have been around, have a couple of sort of, have been around for sort of long enough over the last couple of 10, 20 years and experienced similar downturns like this.
Yeah.
We sort of like those particular managers.
Okay. All right, Robert, thank you for joining us. Really appreciate your insights.
Thanks, Nadine.